There exists a market far larger than most people realize. This is the derivatives market, a place where contracts are built on contracts. Here, exposure is traded without ownership. Leverage amplifies both opportunity and risk. For decades, derivatives have evolved from simple hedging tools. They are the central nervous system of modern finance. Derivatives connect institutions, markets, and nations in ways most people cannot see. Yet, they dictate the flow of capital, the perception of risk, and the stability of economies worldwide. At its simplest, a derivative is a contract whose value derives from something else. This could be a stock, a bond, a commodity, a currency, an interest rate, or even weather patterns. While the concept sounds straightforward, the implications are anything but. Originally designed to manage risk, derivatives allowed farmers to hedge crop prices. Airlines could protect against fuel fluctuations. Banks could safeguard against interest rate swings. Corporations could lock in currency rates for international transactions. Hedging was the noble origin story. Yet the evolution of these instruments has transformed them into mechanisms for leverage, speculation, and complex financial engineering. Today, investors can control massive exposures with only a fraction of the capital, amplifying profits and multiplying losses. The global derivatives market has grown to unfathomable scales, with notional values exceeding hundreds of trillions of dollars. Even if much of that is theoretical exposure rather than actual risk, it illustrates one critical fact: the system is massive, interconnected, and potentially fragile. Derivatives create interdependence. Each contract binds two parties together in obligations. If one party defaults or fails to meet margin calls, the other absorbs the shock. Multiply this by millions of contracts across thousands of institutions, and you get a dense web of obligations that links markets worldwide. This is the derivatives machine. Invisible, complex, interdependent, and immensely powerful. It hums quietly during calm periods, but under stress, it can propagate shocks faster than any other mechanism in finance. Leverage is central to this dynamic. Derivatives allow exposure far beyond the capital invested. Small movements in the underlying asset can result in large gains or catastrophic losses. This magnification effect has caused near collapses repeatedly. In 1998, long-term capital management nearly triggered a global financial disaster. Its highly leveraged derivative positions could not absorb volatility in the bond markets. In 2008, mortgage-backed securities combined with credit default swaps created a chain reaction. This toppled institutions, froze credit markets, and required coordinated intervention from central banks. The derivatives machine is not inherently dangerous. It is a tool. But scale and complexity amplify fragility. Modern derivatives include interest rate swaps, credit default swaps, currency and commodity futures, options, volatility contracts, total return swaps, and synthetic exposures. They allow risk transfer and capital efficiency, but they also concentrate exposure. Clearinghouses mitigate some risk by centralizing counterparty obligations, yet they themselves become critical nodes. If a clearinghouse falters, the consequences ripple through global finance. Derivatives interact directly with debt, liquidity, and policy. Interest rate derivatives respond to central bank decisions. Currency derivatives reflect geopolitical events. Commodity derivatives react to supply chain disruptions. Equity derivatives amplify stock market movements. When these instruments are functioning normally, they provide liquidity, hedging, and flexibility. But when volatility spikes, correlations converge, liquidity dries up, and leverage forces participants to adjust positions rapidly. This accelerates price movements and magnifies systemic risk. Modern derivatives trading is instantaneous, driven by algorithms executing millions of trades in milliseconds. Models continuously calculate exposures and risk limits. But these models are only as accurate as their assumptions about correlations, liquidity, and market behavior. When assumptions break, feedback loops intensify losses. Selling triggers further selling. Margin calls trigger asset liquidation. Volatility surges. The system, which appeared stable moments before, becomes chaotic. Derivatives also create synthetic exposure. Investors can gain market exposure without owning the underlying asset. This can inflate apparent demand and exaggerate price movements. Markets may respond not to fundamentals, but to the positioning flows of derivatives. These hidden forces amplify trends in both directions. They create the appearance of stability or chaos depending on who controls the flows. One of the most dangerous aspects is interconnection. Derivatives bind institutions globally. Many contracts are denominated in US dollars. Banks, hedge funds, insurance companies, and corporations rely on continuous funding and liquidity. When liquidity tightens in one corner of the market, stress can cascade across institutions and borders. Central banks may intervene with swap lines, emergency liquidity, or quantitative easing to stabilize these markets. This reveals just how deeply derivatives are embedded in policy and stability. Despite regulatory reforms since 2008, increased transparency, clearing requirements, capital buffers, and stress testing still exist. Complexity continues to grow. New instruments, structured products, and exotic derivatives layer additional exposure onto an already intricate web. Each innovation increases interconnectivity, adding potential points of systemic failure. The derivatives machine is constantly evolving, adapting, and expanding its reach. The derivatives machine does not create risk. It redistributes it. It moves risk from one participant to another, concentrating it in some places while alleviating it in others. But at scale, hidden vulnerabilities accumulate. Confidence and liquidity are the lifeblood of the system. Remove either, and the interconnected web transmits shock rapidly. A single default can propagate collateral calls, forced liquidations, and volatility spikes in a fraction of the time it would take for traditional markets to react. Understanding derivatives is not about fear. It is about recognizing architecture. Leverage, counterparty dependence, synthetic exposure, and networked complexity are all structural features. When combined with high debt, liquidity dependence, central bank intervention, and inflation pressures, the derivatives machine becomes the amplifier of systemic risk. It is the engine that can accelerate both growth and collapse. In calm periods, the machine hums invisibly. Risk appears quantified. Exposure appears managed. Volatility seems contained. But history shows us that under stress, this web of contracts magnifies losses. It propagates panic and accelerates crisis. The derivatives machine is not evil. It is human ingenuity applied at a scale that few can comprehend. Its power is real. Its fragility is real. To navigate modern finance, understanding this machine is essential. The derivatives machine runs continuously, silently shaping markets. It influences asset prices and amplifies both opportunity and danger. It is the circulatory system of global finance. Invisible to most, indispensable to some, and terrifying when strained. While it is impossible to predict precisely when strain will become crisis, understanding its structure gives insight into where risk accumulates. Who benefits, who absorbs losses, and how global finance is engineered to function or fail. The next time you see sudden volatility, a market sell-off, or a surprising price spike, remember, behind every price is a contract. Behind every contract is a chain of obligations. Behind every chain of obligations is leverage, liquidity, and trust. And behind all of that is the derivatives machine, running silently, invisibly, and powerfully, shaping the fate of markets and economies across the globe. Welcome to Cash and Chronicles, where money, power, and history collide.